Very good afternoon to you all, friends. I'm Sanjeev Singhal, Chairman of the Sustainability and Reporting Standard Board and Chairman Sustainability Reporting Standard Board. I, on behalf of myself and my Vice Chairman, CA Vishal Doshi ji, welcome you to this 55th program of the AASB for this council year. Today's topic is audit of loans and advances and borrowings. Friends, it's been a constant endeavor of the AASB to equip our members with the finer points of each of the auditing standards. That is why we have run this series. We have covered all the auditing standards. We have covered CARO, and now we are covering item-wise elements of the financial statements. And there's been overwhelming response from the members. Even in today's program, 1,360 members have already joined. And friends, it's indeed a pleasure that we have two very renowned faculties today, CA Sukrut Mehta and CA Amit Chok, who will enlighten all of you with their practical exposure. And this audit of loans and advances and borrowing, when we are talking about, we will cover, the learned faculties will cover all the aspects of auditing, whether it's the auditing standards, whether it's the company law, or whether it's the accounting of the same, which is evaluated by doing the audits. And I have with me, it's really a great pleasure to welcome my council colleague, CA Purushottam Khandelwal ji from Ahmedabad, from the vibrant city of Ahmedabad. Purushottam bhai is in his first term of the Central Council, and I see him working. He works with a lot of energy, passion, and zeal, and whatever responsibilities are given to him, and he's a very fine organizer. You give him a task and he will execute it to the perfection. And he was the chairman of the Ahmedabad branch when our current Honorable Prime Minister and the then Chief Minister of Gujarat, Narendra Bhai Modi ji, when Narendra Modi ji was the keynote speaker. So his capabilities of organizing the programs and executing them to the finest are well appreciated. And I'm thankful to him that he has agreed to be a keynote speaker for today's session. Welcome you, Purushottam bhai, and I request you to give your keynote address.
Good afternoon. My colleague in the council and chairman of AASB, CA Dr. Sanjeev Singhal ji. Thank you, sir, for giving me an opportunity to interact with the members. Vice chairman of this committee, CA Vishal Doshi from Baroda, my dear friends. Speaker of these sessions, Sukrut Mehta, whom I know long time. Sukrut ji, I know I'm knowing you so many years. Is one of the finest speaker in this topic. Respected members, it gives me immense pleasure to be interact with you as a keynote speaker on this topic. The topic this is selected by AASB is a very relevant in the current scenario and the season of the audit. The audit consideration while auditing loan and advances and borrowings. So there is a huge responsibility cast on the auditors to do the proper audit of the loans and advances and borrowing both, because the loan and advances form a significant portion of total assets. Loan advances may be long-term advances or a short-term, whether it is unsecured, whether it is unsecured. You have to go through the proper procedure and proper sanction, and your power, whether you are eligible to grant the loan and advances or not. So it's a very, very, very important, it's a major portion of the asset, whether you are the interest which you are charging on the loan advances regularly receive or not. So we have to take the lot of cares to the advances of loan advances. For the some is the borrowings. When companies borrowings, we have to check whether the capacity of the directors or a company is whether in the limit of the borrowings or a not. Again, it's a borrowing, maybe at what rate of interest, from whom you are taking borrowing. So my humble request to members to do the proper audit of loans, advances and borrowings. And I will not take much of your time because Sukrut bhai is here and you all gathered to hear the Sukrut bhai. Mehta, thank you so much for giving me an opportunity to interact with members. Thank you so much.
Sanjeev. Thank you, Purushottam bhai. Thank you for a very crisp keynote address. And this is what we are known for being crisp and to the point. straight to the point. Thank you so much. So with this, now I request Sukrit to kindly start the technical session. Over to you, Sukrit.
Sure.
And perhaps, Sukrit, this is your first program with AASB. So we welcome you as the speaker in the AASB for this council. Thanks, Anur.
Yeah, thank you so much and looking forward. I hope I'm audible. My voice is very clear.
Yes.
Right. So before I start, I would like to thank the honorable council members for bringing me over here for this session. A very good afternoon to Sanjeev, Purushottam Bhai, Vikas ji, Anil ji for organizing this, fellow professional colleagues and friends. I would just present my screen and start with the session. So, is my screen visible? I'm audible?
Yes, sir. Yes, sir.
Right. So thank you once again, and I'll start. The topic for the day: audit considerations while auditing loans and advances. Over the next 30-35 minutes, what I'll do is I will take you through various aspects pertaining to this topic. And then, for the balance time, would be happy if there are any questions, interactions, etc., from any of the members. As we, as we see on the screen, the words audit considerations. So the considerations are towards auditing this caption of financial statements, which is loans and advances. Let me, before I start and deep dive into the topic, take you back to the drawing board and ask a very mundane and basic question that we know as to what is audit, right? Since we are talking about audit consideration, we'll start with that. There are, right since years, we have been hearing to the definitions of audit. We have been performing audit. All the books that we have around have various definitions of what an audit is, what an auditor should do. I just like to add one more aspect, which according to me is most important aspect. And that is, while doing an audit, the ability to think. We can call it a critical thinking as well. For me, audit is how well we can think through. Think through the minds of the originator or the creator of the transaction. Thinking through the journey of the transaction, that is right from the birth to the death and the logical conclusion of every transaction. We weave in that our professional skepticism, or the other word is critical thinking on every aspect of the transaction, like what this transaction is all about. Does this make business sense? Is it a usual transaction? Would a rational business person enter into this transaction? Is it for a fair deal for the company in which I am auditing? Thinking about what are the controls the management has put in place throughout the transaction, that is origination, monitoring, and completion of the transaction. And thinking about the requirements of applicable laws and regulation, and including presentation and disclosure pertaining to that particular transaction. I think weaving all these aspects can be considered as one of the complete package of an audit. Audit is also thinking about what's the outcome of the audit. The outcome of every audit is reliance of your work by various stakeholders. It may be owners of a company. They may want to ensure that all their employees are doing a proper job. there's no leaks. It may be investors of the company. They may want to see whether the management is running the company properly. They may be authorities. So, thinking and weaving all these aspects in every aspect of audit, every caption of a financial statement is what I call it as a critical thinking, which is one of the important aspects. And especially in the present day situation, these things become very important when we audit any aspect or any line item in a financial statement. I think with this as a background, let me start on the discussion for the topic of the day, which is audit of loans and advances. Just to quickly, again take you back to the drawing board. Loans, as we understand, is defined in our books as something which represents the claim of an entity in respect of any collateral contractual obligation for the money lent. And advances, obviously, is the payments which are made before completion of a contract or before acquisition of goods and services. When both these aspects, one thing is common is that the company is parting with money. Company is parting with its funds, which either it will recover it as it is along with interest, or it will get goods or services in return of the advances that have been given to the opposite party. So with this background, if we see any financial statement, and I'm typically taking an example, say, of a manufacturing or a service company, where you will find some particular captions as far as the loans and advances are concerned. I've divided into three. One is advance to suppliers, which is usual for any business to run. It's in the normal course of a business that they may want to, or they may have to give certain advances before procuring the goods or services. There may be companies which may be working under a more complex group structure. So there may be a parent, subsidiary, joint venture, associates, and for running their operations, certain loans and advances might be given to them, or some of the other related parties like KMPs or directors. And third is the normal loans that we see given in the normal course to or not a normal course to a third party. So we'll cover all these aspects during the course of the discussion on what could be specific consideration that may be looked into during the audit of each of these financial statement captions. But before we go to the specifics, as a precursor, whenever we again audit and blending, or weaving the aspect of critical thinking, it's important that we evaluate the tone at the top, the tone at the management level in every auditee that we audit. In the sense, what's the governance process? Are there policies and procedures in place, and the depth of them? Is there a regular evaluation of design and implementation effectiveness of the procedures laid down? There would be procedures, policy, but is that on a paper, or is it actually implemented? Is there a constant evaluation whether the policies and procedures which are laid down are working, or does it need any design changes? Is the implementation of these procedures and policy monitored at a regular interval, say by way of monthly MISs, or as the transaction happens by way of IT controls or manual controls? Is there a mechanism in place to monitor what is designed is implemented effectively? And then is there a process whereby if there are any exceptions, then things get escalated and highlighted to the management? So these are some of the aspects, while there are many more, which I thought are the key aspects which we usually evaluate while evaluation of tone at the top. Coming to the policies and procedures that we mentioned, I think it's important that these are detailed and having adequate depth. There would be, you may come across scenarios where there is a policy in place, but is it detailed enough? Does it cover all the aspects that it is required to? Whether again these procedures and policies, as I said, are reassessed for its effectiveness for the particular kind of business. Is an adequate, for example, authority matrix laid down as to who can give advance? What is the limit up to which the advances can be given? Is there any evaluation of purpose? Is there a specific procedures laid down for evaluation of the purpose, or say, evaluation of the party to whom the advance is being given? Is there a specific procedure laid down that any advance which is given should be backed by adequate security? Agreement has to be there. If it's an advance to a vendor, whether the credibilities and credentials of vendors are evaluated. So these are some of the procedures, which would create, depth in the standard operating procedure, which the companies usually would have. And then, of course, everything may not be laid down. So if at all for running a business, if there are any exceptions to be created, then is there a mechanism to ensure that all the exceptions are approved and authorized by an appropriate authority within the organization? Having said that, weaving our tone at the top, policies, procedures, and critical thinking that we have spoken about, I'll now go through the three aspects of loans and advances that we spoke about, and would touch upon a few specific aspects on audit of these loans and advances. And these procedures, once you have evaluated the tone at the top, once you have evaluated the policies and procedures and adequacy of it and the design effectiveness of it by way of a walkthrough, you will then like to test in both ways. One is the control aspect of all the policies and procedures in place, and also do a substantive testing by way of verifying the documents, underlying supportings, etc., etc. Now, when we are usually seeing advances to supplier, again, are we questioning ourselves as to why an advance has to be given? I mean, what's the need for an advance to be given? It's a competitive world, so is it really required to be given? Answer to that might be maybe benchmarking with the past, or it is an industry practice, or the kind of transaction that the company enters into, the kind of vendor that the company is into requires the terms whereby we have to accept certain terms from the vendors. So be it. I mean, that's a normal way of looking at it. But again, one needs to think through whether this advance meets the normal industry practice. Is it happening at all the places, etc.? Is the advance in adherence to the SOP laid down and as per the PO terms? So the approval and the advance which is given is as per the PO terms. Now, this is something I would like to highlight as to, is this advance which is given to the supplier way above the normal supply which is expected from the vendor. Over next 6 months or no, over next 9 months, whatever are the supplies that I'm expecting from the vendor, have I given much higher advance than the normal supply cycle of that vendor? Then we need to wear our professional skepticism hat and dig deep into what is the nature of advances, why such a high advance is given, what's the recoverability, is it a loan or actually an advance that needs to be assessed and evaluated. There might be cases where advances given in the name of advance to suppliers and they are received back as it is. So maybe even in such scenario, one needs to maybe look at the specific bank account transactions of money flowing in and out, and whether actually there was an advance or it's just kind of a loan, and all the terms and conditions that are required for giving a loan have been adhered to. And obviously, while auditing, we evaluate the aging of advances, the nature of vendor, what is the goods that vendor is supplying to us, etc. Backed by if there are any old dues, critically evaluating and discussing with the management on the recoverability of those advances, periodic balance confirmation, reconciliation of the account statements, and obviously assessing the communications as to why are there any communications with the suppliers as to why these advances are aged and how are they going to be recovered, and whether there are any disputes, because these would have an effect on the financial statements. IP testing, that is the information provided by the entity. Are we taking the information as it is, or are we doing collaborative tests that the information that we have received is a complete information, is an accurate information, and is actually an existing information? So the completeness and accuracy of the information needs to be tested for whatever information we receive from the company, rather than just accepting that to be true. I'll move to the next aspect, which is advance. And some of these matters, though we have bifurcated into 3 categories, some of the matters are interchangeably applicable, but I've classified it to the most appropriate kind of a group. Now, when a company gives an advance, it's working in a group structure, and it has various subsidiaries, associates, joint venture, and a large group. It's very critical, to again critically evaluate the advance which is given to the group. There are various regulatory aspects also which the company needs to ensure that they are in compliance with. For example, the requirements of Section 186, which limits the amount of advance which can be given, approvals required before giving the advances, the rate of interest at which the advances needs to be given. There might be a bit of a twist here if a company is having borrowings on its books on one side, and they have given advances on another side. Maybe it's important to consider certain aspects, like whether the interest which is given by the company is meeting the arm's length requirement as well. Because my borrowing rates, if that's much higher than the rate at which I've given the advances, that may not meet those tests. Not only that, when I'm having this situation of borrowing and advances, also need to evaluate the terms at which I've taken the advance and the terms at which I've given the advance, secured, unsecured, etc. Needs to be considered while evaluating whether it's at arm's length. If I've taken a secured loan and I've given an unsecured loan, then obviously the rate of interest has to be much higher than the rate of interest that I'm paying for my borrowings. Another aspect is the term of the loan at which I have taken and I have given. If I have taken a short-term loan and I have given a long-term advance, then again that will have a repercussion on the cash flow positions of my clients' financial statements. And hence, that's another aspect which needs to be considered while evaluating, the cash flow positions of the company and the repayment ability of the company for the borrowings. Obviously, that will be covered in the next session. But yes, that's again has to be evaluated from an arm's length perspective. In a group structure, it may happen that some of the subsidiaries are incurring losses, and hence, if there is an advance, there is an exposure that's sitting on my financial statements for the losses that has been incurred by the subsidiary, and I have advanced an amount to that subsidiary which is way above, and it's quite possible that the net worth or the profit of that company is not there, and the net worth of the company is significantly deteriorated. So in that case, again, whatever is the advance sitting on standalone books needs to be evaluated if there is a ability of that company to pay back my funds. What are the management plans? What's the history of achieving of those plans? Critical assumptions that typically we may receive for recoverability of such advances like growth, the discounts, etc., needs to be looked back and mapped with the past performances, plus the concrete evidence that this advance will be received by me, and I don't have any exposure on account of any impairment of such advance needs to be evaluated critically. Also, we're talking about in a related party transaction. Suppose there are any issues with regards to limits, which I can give an advance up to. It's quite possible that I have. That's why I classified that as trade advance or advance to supplier. It happens to be a related party. It becomes very critical again for me to evaluate and assess whether actually this is in the nature of a loan or in the nature of advances, and I have any regulatory or in other implications in this regards. Implications might be there again if such advance is given as advance to supplier, whereas I have again borrowings in my books, and the purpose for which I have borrowed is not maybe to give it for my businesses. So it may meet that particular definition, but actually whether it's a trade advance or it's a loan transaction, that will determine if there are any further repercussions or not of that particular advance. Also, in a group transactions, as we hear in some or the other forums, as to we spoke about the procedures, policies in place for approval of those group advances, the tenure, etc., which also is a regulatory requirement as far as Companies Act and even SEBI is concerned. And hence, it becomes that much more critical to evaluate that there is a specific monitoring mechanism of utilization of the advances given to my group companies. The purpose for which it was given, it has been utilized for the same purpose. There is no further cascading of that advance to a third party or to any other group company whereby it defeats the purpose. So what I'm trying to say is, if at all loan is given for an approved purpose, the loan either is sitting in that books. The utilization of that loan, there should be a proper monitoring mechanism for recovery of the loans and advances within the stipulated time, and that the utilization of that amount has happened only and only for the purpose and the reason for which this has gone. Things get a bit complicated when you're a parent company auditor, and maybe there is another auditor, and you may not have access to the books. But then, as a principal or a parent company auditor, you can ask for specific information because you are giving an opinion on consolidated financial statements. And there are regulations forthcoming regulations to strengthen these aspects as well in future. The terms at which these advances have been given have to be again assessed, as I said, at arm's length, and it's important that there is an appropriate reconciliation and balance reconciliation of this within the groups. It is quite possible at times that there are transactions of revenue nature within the groups, say reimbursement of expenses, or incurring some expenses on behalf of my subsidiary or a joint venture, etc. So it's important that these balances are periodically reconciled. At times there are disputes or non-agreement of these balances. It's quite possible that the balances are tied in the books, but the difference is parked in some other account. So it's important to scrutinize all the group company balances to ensure that those things happen. And obviously, the disclosures of the related party transactions. Again, some of the critical aspects, which I have said, are interchangeable between the three categories of advances. When you're giving a loan to a third party, say, for example, you are in a manufacturing setup and you are giving a loan to a third party, or a service setup, and you're giving a loan to a third party. The first question that comes to the auditor's consideration is why an advance is given. And as I said in the beginning of the presentation, as to it's important to evaluate whether this transaction is a usual transaction. Does it make business sense? Would a rational businessman have entered this transaction at the terms and conditions at which this transaction is entered into? So those are the critical aspects which needs very deep evaluation before taking any positions. Obviously, loan to a third party, it's important that there is appropriate monitoring mechanism, that whatever loans are given, the interest as well as the principal is recovered as and when it was expected. If not, then as a policy, as a procedure, there has to be an escalation or an exception mechanism whereby any such loans are periodically highlighted to the appropriate levels, maybe the board level or an audit committee level or a managing director level, and ensure that the company doesn't have any exposure in this case. If at all there are overdues in terms of receipt of such loans and advances, it is important to evaluate whether it warrants any impairment, and whatever assumptions that we saw in the previous slide is applicable over here as well as the communication and correspondence the company is having with those third parties for the overdue balances. Sometimes what we see see is there are changes in the terms, whereby reduction of interest or knocking off whatever amount is received against the principal first rather than knocking it off against the interest. But it's important that the procedures and processes are in place, and it's ensured by us as an auditor that knocking off also happens appropriately, first against the interest and then against the principal, so that the company doesn't suffer and doesn't become a prejudicial to the interest of the company. Also need to evaluate if there are old outstanding defaulted advances, whether the company has gone legal or issued any legal notice for the purpose of realization recovery of advance along with the interest. Then depending upon the strength of the case, maybe you can go in for a legal confirmation or a lawyer's confirmation, independent confirmation, to ensure that the exposure on the books is appropriately taken into consideration. We also need, and as Purushottam ji also said a while back, that these things are becoming very critical from our auditor's standpoint. So not only we need to critically evaluate every aspect while doing the audit, but there are lots of disclosure requirements which have come into place. As we all know, the new CARO requires various aspects to be covered by the auditor, but even the company needs to have certain disclosures additionally to what they were doing so far from a Schedule 3 perspective. So, for example, if there's a loan given without any stipulation, or loan is given to the promoter, then what is the percentage of total loan given as such, as a percentage of total loans? If there is a loan which is given without stipulation, then what is the percentage of such loans as a percentage of the total loans which are given, etc., etc. Are various disclosures which have to be given. Apart from this, the existing disclosures like 186(4) of the Companies Act also mandates various aspects to cover the nature of loan, the amount of security which is there to back up the loan, the terms of the loan. All those aspects needs to be specifically addressed. And also additional aspects like Rule 11E, which has come up from a disclosure perspective. It's representation by the management, but it's good to disclose any of those disclosure aspects as well in the financial statements, as we are supposed to report that in the audit report as well. While we spoke about the reporting requirements, I'll just quickly allude to these reporting requirements, which have been brought to by CARO 2020. I'm sure a separate session has happened and would be required to get into nuances and details of all these things. The only aspects to be considered by the auditor is if at all a loan is given during the current year, and it's not outstanding as of the balance sheet date, but still a disclosure is required by the auditor's report. So we should be mindful of that particular aspect, that even if there is no balance at the year end, but a loan is given and repaid, even that those needs specific disclosure as part of the reporting requirements which has come in. We spoke briefly about what could be the matters which are prejudicial to the interest of the company, which is again a reporting requirement, a continuing requirement. But one thing over here is, if at all, by virtue of our audit procedures, we evaluate that the loan which was given to our group company, or any loan which is meeting the reporting aspect, that is somehow not recoverable and is provided or charged off in the books, even that will be considered as prejudicial to the interest of the company, and appropriate reporting requirement would trigger in such things. We spoke about various aspects to consider whether the rate is appropriate, the security is appropriate, the terms of repayment are appropriate, whether it's meeting the covenants, etc. So that needs to be taken into consideration while ensuring that it's not prejudicial to the interest of the company. Also, things needs to be considered as to whether all the laws and regulations have been complied with. If not, then even that would warrant reporting. For example, if one has given a loan in excess of the limits which are prescribed, or and then there is no special resolution or board resolution passed to ratify that aspect, and that will then be considered for the purpose of reporting over here. So that also needs to be weaved in to the audit procedures which we follow for auditing laws and loans and advances. Also, we spoke about if there are any loans without stipulations, that needs to be appropriately evaluated. Here it talks about the original agreement at the time of giving the loan, whether there was stipulation or no stipulation. That aspect needs to be covered. Loans to promoters, obviously we spoke about, and that requires appropriate evaluation, whether it warrants any reporting requirements. Related party, of course, the disclosures that we spoke about, all the terms and conditions and all the aspects of related party disclosure requirement as per the accounting standard needs to be ensured that those are appropriately done. Verify wherever there is a stipulation whether the loan is recovered regularly. If not, then whether there is anything which is overdue, and hence a disclosure specifically will be required. So need to weave that into the audit procedures while doing the audit of loans and advances. Again, evergreening of loan. This particular thing is very typical kind of topic as to whether, if at all, there are any fresh loans given for repayment of the existing loans, or there is an extension of the existing loans. So that aspect needs to be checked by the auditor. So have a look at the terms of the loan, the repayment schedules of the loan, and what happens on that repayment schedule. Whether there is any either cash flow transaction, bank statement transaction, whereby one loan is taken and the other loan is repaid, or the existing loan is getting extended. In both the cases, it will warrant an evaluation from an auditor's perspective, and reporting needs to be done. So is the case, whatever we have been disclosing under Section 185 and 186 of the Companies Act, which talks about loans to directors and the companies where they are having significant influence. So all the matters that we spoke about as a loan to a related party or loan to a group company is applicable to the loans to directors as well. So that needs to be taken care of. I'm conscious of time, so just to touch upon the last aspect, which is again an important aspect, which is come in as a part of the reporting considerations by the auditors, and that's where we need to weave in additional procedures while doing the audit of loans and advances. That is, if I have funded to any of the company, whereby that fund will be further given to a ultimate beneficiary, or if I have received any funds, wherein that fund has to be transferred and given to another company who is the ultimate beneficiary. In both the cases, it's important that so there are specific reporting requirements in both the cases. While primarily it talks about taking a representation from the management, it also puts a lot of onus on the auditors to carry out the procedures to ensure that the disclosures which are made in the financial statements are appropriate. This is one of the difficult thing, because there may not be a written agreement, written understanding. Even oral understandings, if at all there are, there is a requirement to disclose such things. As an auditor, to an extent possible, apart from just taking a representation letter, it's important that we seek from the management, if at all there are any fund movements for any loans or advances that we have passed on to an intermediary company, and the financial statements or books of accounts of that company has corresponding fund movement to a third party, or which would be a group company or a non-group company. It's important to get into details of all such transactions. There may not be a one-to-one mapping, but then if on an overall basis, to an extent possible, we should seek from the management underlying, obviously, supportings, the purpose, the filings that the management does, the investment and loan register that they would maintain when they are funding to the parties. From a governance perspective, the board resolutions which approves the purpose for which the funds are given, the authority which is approving this particular funds, because there are limits which are set above which the funds cannot. So even board play will come into picture. So to an extent possible, as an auditor, we need to collect as much corroborative evidence as possible to ensure, apart from the representation, to report that the representation that we are speaking about, we are relying upon, is not prima facie in line, and the disclosures which are made by the management looks appropriate or not. So I think this broadly, were the things that I thought I would cover, covering various aspects of loans and advances. In particular, touching upon certain specific things, and not the routine mundane things which we usually see, like agreements or underlying documents, etc. But from a flow perspective, if I were just to summarize, evaluate the tone at the top, evaluate the policies and procedures, adherence to the policies and procedures, evaluate the the valuations that are carried on the books, evaluate the movement of the funds which happen within the company, evaluate the terms at which these transactions are happening. So weave in professional skepticism at every stage of the transactions, and I think that that is really a need of the day, because a lot of stakeholders rely on our report and our work. So more robust and critically thought through audit procedures that we plan, the better it is. Thank you so much. If at all, any questions, happy to take.
Thank you so much, sir. Can you hear me?
Yes.
Thank you so much, sir. It was a wonderful deliberation and in a very lucid and very elaborative manner. And thoroughly, we have gained a lot through your deliberation, sir. Sir, I have received certain questions relating to this. If you permit, can I ask certain questions received from the members, sir?
Oh, yes, definitely. I mean, to an extent possible, I'll address them. Otherwise, we can park it.
Yes. Sir, whether holding advance for customers for over 1 year attract public deposit rules?
Yeah. So if I received advances from customers, right?
Yes, sir.
So I'm talking about I mean, that ideally, is not part of the advance given. It's an advance received. But then, yes, if you see the acceptance of deposit rules and the definitions which we have for the deemed deposit, the reporting requirements which have been laid down by CARO 2020, there are certain exemptions given. Not in all the cases will this be construed as a deposit under acceptance of deposit rules. But yes, primarily if it is received and lying unadjusted for over 365 days, then one needs to evaluate whether it falls under the definition or a purview of deemed deposit and needs reporting and compliance requirements.
Yes, sir. So loans and advances not given by the company but transferred due to the merger, whether it will be violation of the section 185, 186 of the Companies Act 2013, and what is the duty of the auditor for reporting relates to this?
This is an interesting question, actually. It needs much more specific information and further detailed information, because 185, 186 are company specifics, right? So the company which has parted or given such advances needs to be evaluated from that company's perspective. If that company is merged into another company and that advance is carried forward to the merging company, one has to evaluate whether the directors of that company continue to be directors of the merged company.
Yes.
The limits at which they were given, whether it's bursted or whether it is in adherence to the limit, whether that needs to be evaluated. So it's an interesting question, but needs much more information, from a conclusions perspective.
So can a private limited company borrow money from a trust or a partnership firm? In the said company, there are 4 shareholders and the directors being husband, wife, and 2 sons. In the partnership firm, the partners are mother and 2 sons. In the trust, the trustees are all the 4. The trust has obtained collateral security and the rate of the interest charge is 2% more than the bank deposit rates.
I leave something for my colleague speaker, actually, because this pertains to borrowing.
Borrowing. Yes, we'll take from this. Sir, similarly related to this, how to unearth loans to related parties? Must as advanced when there are frequent trading transactions with the said parties.
That's what I alluded to, actually, that particular aspect. It's very interesting, actually. Maybe certain aspects like, so there are various aspects to it. One is whether the company has a borrowing, whether the company doesn't have a borrowing. Presuming a company doesn't have a borrowing and it has given advances much more than the advance that's required to be given, or the purchase order or the supply that is expected from that particular company. Obviously, one needs to make dwell deep into and make very detailed inquiries as to why such advances were given, which are much more than what is expected. It's quite possible that initially the company was intending to place a higher order, and then because of market scenario, market conditions, whatever it is, it curtailed its order or curtailed its PO, and hence we feel we feel that the advances which are given are much higher. But if that is not the case, and genuinely the advances given are much more than what I expect to receive in the next, within the operating cycle, which is say 3 months, 4 months, 5 months, then one needs to evaluate whether this actually is an advance to supplier. It's more to do with the funding of your supplier, and it's to be classified some portion of it as loan. Things will be much more interesting when the company has borrowings on the books and has given such advances. And as I covered as part of some of the aspects in the presentation, as to we need to evaluate whether what are the terms at which I have given advances, whether these advances are lying for long with the suppliers, and I have a short-term borrowing in my books. So how am I going to repay my debts when I'm not going to receive either the advance or the loans per se, I would say, or goods which I'll then sell in the markets and then repay my debts. So if it is, I would say it needs definitely needs critical evaluation. If at all I have paid advances which are much more than usually what I expect the goods to be received from the supplier.
Yes, sir. So one last question relating to the Rule 11E. As per the Rule 11E, how should the disclosure be made when the parent company advances money to subsidiary for its regular business?
Yeah. So 11E per se, talks about who's the ultimate beneficiary, right? So if the subsidiary is where the buck stops, then it's a normal loan. It's not there. 11E will come into picture if I'm A and my subsidiary is B, and I'm giving the funds to B for further giving it to C. Then the disclosure requirements will fall in place. But if it's a normal loans and advances, then evaluation of the other terms and conditions, whether it's prejudicial or it's at a normal terms and condition, what a normal business transaction or in the usual course of business I would have given the advance would stand true, and 11E will not come into picture then. But yes, it'll take 30 seconds more. As I had said, it's important to go to the root and the nature of this particular transaction as to if I'm giving it as a business advance to my subsidiary, whether it is actually a business advance or there is a corresponding in his financial statement there is a corresponding funds which is moving out to a third party. If that is true, then even if it is given under the cover of a business advance, this may warrant disclosure under 11E and a discussion with the management.
So, sir, thank you so much, sir, for such a wonderful deliberation. On behalf of Auditing and Assurance Standard Board, I extend my heartiest thanks towards you for sparing your valuable time, even after a very, very busy schedule these days, after having so many audit committee meetings. So thank you so much, sir. Thank you so much.
Thank you so much. Looking forward to it. Thank you.
Thank you. Thank you. Thank you. Thank you. Moving towards the next technical session, we are having with us CA Amit Chokji. Amit ji, welcome.
Good afternoon. Good afternoon, Anand ji.
Amit ji, welcome to you on behalf of AASB of ICI. सबसे पहले आपका भी बहुत-बहुत धन्यवाद, as you were in the audit committee meeting and still you make it possible to join today, and thank you so much for joining. Amit Ji is a BCom honors graduate from Shriram College of Commerce and a chartered accountant over more than 20 years of experience and 3 years in the 20 years in experience in audit and accounting. He is currently working in partner with SR Botley and Company and in their audit practice. And he started his career with SR Botley and Company and has been with the work and has been working with the firm since its starting. And professionally hailing from the audit of the background, he has involved in several Ind AS audits, IFRS audit, capital market transactions, and Ind AS conversion projects at large PSUs, multinational corporations, and Indian groups. He has been associated with Institute for various forums since 2008 and a regular faculty at the various platforms of ICI. And he has given so many lectures, so many seminars, webinars, and virtual CP meetings. So once again, welcome Amit Ji on this today's very important VCM. We have covered so many things by our learned co-speaker, CA Sukrut Mehta ji on loans and advances. So one part is left, that is another very important aspect, that is the borrowings. So may I request you to please deliberate on your topic, sir, relating to the borrowings.
Thank you, Anilji. Thank you. I'll just share my screen. Just let me know when the screen is visible so that I... can
Yes,
you
sir.
see?
Yes, sir. Fine.
All right, sir. Just a minute. Sure. So good afternoon, everyone. Good afternoon, members. And thanks, ICI, for giving this opportunity. Now, borrowing cost historically, or even right now, it seems a very simple topic when we talk about auditing of borrowing cost. And yet, 100% of the, I would say that frauds that have happened in the country, you name any big fraud or any kind of a misreporting that would have been observed, borrowings is definitely at the center of such unearthing of misreporting or wrong disclosures. It has assumed a lot of significance in current scenario. And even while the regulator, the ICAI regulatory bodies or reviewing bodies look at it, this is one key area wherein the focus is a lot. And the very simple reason is that whenever there are borrowings, there is public money that is involved. And whenever there is public money that is involved, the kind of vigil the regulator would have would be much higher compared to some of the other things. So we'll broadly cover. So how I have divided this presentation is to bring out certain key consideration that one must keep in mind while auditing borrowing or the borrowing caption in the financial statements, and what are some of those key considerations that you should have in mind. And I have also broadly put together an audit program of a large corporate, which would have short-term, long-term, all kind of borrowing as to how would one approach as an auditor. And then followed it up with some of the key considerations in the new CARO that are there with regard to borrowings. Now, key considerations, and the first thing, which appears to be one of the most simplistic procedure, but considered as the most important procedure, whether you talk about the Indian regulator or regulator anywhere across the world, is external confirmations. Now, third-party evidence I mean, there's a rebuttable presumption while we are auditing that for any account caption, if you can get an external confirmation as one of the evidences, then that evidence supersedes any other kind of a confirmation, any other kind of an evidence. So external confirmation should be your go-to procedure or go-to consideration the moment you are thinking of auditing borrowings. And not just external confirmations. Now, there have been times in some of the frauds that have been unearthed in our country and across. And again, I mean, in this last couple of minutes, I would have possibly spoken about fraud a few times. Now, you would have seen, read, or the expectation from an auditor is increasing by the day. The regulator is expecting far more skepticism to be exercised by an auditor in the current environment, and which is where the terms like fraud, misreporting, wrong disclosures, it assumes a lot of importance. Now, external confirmation is one key step when you look at auditing of borrowings, and not just a confirmation. Now, there are certain things that one must also look at while you're looking at confirmation. Who is sending out a confirmation letter? Okay, so one has to see as to where is the, so there are two ways that you would receive, even before you receive a confirmation, rather, who is sending out a confirmation. Ideally, the confirmation should be sent by the auditor himself. We must not rely on the client to send out the confirmation. We must obtain a list of all the banks, all the borrowing institutions, financial institutions, and send out those confirmations ourselves. And this is a regulator expectation that while we are sending out these confirmations, we must retain a copy of evidence that these confirmations have been sent by us and have been received by the counterparty. So that evidence need to be preserved as an audit evidence by the auditor. The other thing is, while you're receiving a confirmation, where are you receiving this confirmation from? So there's a slip that comes along with the confirmation if it is a physical confirmation. So we must retain that as a part of evidence. We must review that while we are looking at a confirmation. The other bit is, in today's context, even email confirmations are becoming increasingly popular. Okay, so in case of email confirmations also, one must look at that the domain name that the email is coming from is not a personal domain name. It should not be a Gmail or a Yahoo Mail or a Hotmail. It has to come from a authorized domain of the bank. Also, you must look at the person that who is sending should be a senior enough person in the bank who is sending out. Skepticism would also, in certain cases, you may call out at the bank to check, to rectify whether such person is authorized to send out confirmations or not. And last but not the least, there are instances wherein the banks would not send out confirmation. Then as auditors, we can also go and physically visit the branches and take a confirmation. But while we are taking such confirmation, we must also make sure that the person that we are obtaining a confirmation from is an authorized representative of the bank. You must have seen his either visiting card or a stamp or something that substantiates the fact that you're getting it from the right source. Now, whatever I've spoken in last 2-3 minutes about confirmations is very, very basic. But if this particular step is carried out right, you can assume that more than 70% of your loan procedures with regard to the carrying value, with regard to any other covenants that might be attached to the loan are taken care of, because when you receive an independent confirmation, you're having a confirmation evidence from a person, from a party, which has no biased interest in it. So that it would be an absolute right evidence. There are numerous instances wherein penal interest, additional covenants, limits being taken by the company, hedging instruments being taken by the company are not recorded in the balance sheet. And when you send out these confirmations, the bank or the financial institution would give out a list of all financial relationship that your client would be having with them. And hence, a lot of off-balance sheet items can be brought onto a balance sheet with the help of this basic step. And because of such reasons, this presumes the highest relevance from a regulator perspective whenever you look at borrowings. The second thing is around classification, which is whether it is a current or a non-current borrowing. Now, this also is very, very relevant, especially in context of the revised Schedule 3, as to how much are the maturities that are getting due in next 1 year and how much are long-term. This has a circulating impact also. We would kind of consider that in the subsequent slide, but classification of a debt between short-term and long-term has far-reaching implications than just disclosure, which we would discuss in a while from now. Then there is early retirement or restructuring of debt, refinancing of debt. If there are any refinancing that have happened during the year, what one must see is that how much is the refinancing charges, how much are the restructuring costs that you have paid, how much is the processing charges that you would have paid in the earlier loan. And if it is a subsequent, if it is significant modification, then how do you address for such processing charges on your earlier loan and on the refinanced loan? Then there is compliance and reporting. And of the circulating impact that I said is the covenant testing. Now, whenever you are looking at borrowings, testing of covenants, which are driven out of the loan agreement that you have with the lenders, assumes a lot of significance. Now, there might be a lot of covenants around ratios, covenants around your EBITDA multiples of performance of the company, covenants around interest coverage ratio, and hence what we discussed a bit ago of classification assumes a lot of relevance, because the moment there is a covenant failure, most agreements in India require your loan to be classified as a current loan. The moment you classify a long-term loan as a current loan, then that might mean your current ratio would get further deteriorated, which might mean that even the covenants that you might have tested, suppose a company has 10 different loans, and there are 10 loan agreements that you have. In a particular loan, for example, your current ratio or any other ratio is not meeting, and by virtue of that, you classify that loan as a current loan. What it would mean is that you would have to retest your covenants for all the other 9 loans also, just to make sure that it does not have a circular impact on the other loans as well. The moment it gets classified as current loan, there is a further relevant significance of that as well, which is going concern implication. Now, this is one of the key matters that an auditor is required to comment upon, look at, whether you talk about from a CARO perspective, Companies Act perspective, or any of the incidents of misreporting that have happened, I would say in last 20 years, right from WordCom in 2001, which led to the downfall of Anderson, to Satyam, to any other. So what are the going concern implications? And if I were to just summarize going concern in one line, it is, does the company have enough funds to pay the liabilities that are getting due in the next 12 months? So that's the simple, basic one-line definition of what one needs to see. And if you have, because of covenant failures, because of any other factors, if your loans are getting classified as current, you would assume that as a conservative principle, that the bank would call out those loans in the next 12 months. And does the company has sufficient funds to repay that or not? In a lot of instances, companies would come back and tell you that we would be refinancing these loans in the next 12 months. So while there might be current liabilities that are far exceeding my current assets or the cash that I would be able to generate, however, we would be refinancing our borrowing in the next 12 months, which would give us enough cash. Now, can refinancing be taken as one of the inputs? It is circumstantial, it is situational, and you would have to look at from a case-to-case basis that whether you can consider refinancing as one of the options or not. The kind of things that one would look at is past history of refinancing, whether the company has been successful in the past to do the refinancing, whether they have the necessary resources to do the refinancing, what is the prevailing rate of interest, do they have the necessary security to give for refinancing, Have they been regular in repayment of their loans and otherwise that the bankers would be giving them a refinance or not? And basis that, one has to evaluate on a case-to-case basis whether a disclosure in those two accounts is required, or even to an extent that whether you need to give an emphasis of matter in your auditor's report that there is a refinancing. And why did I say emphasis of matter? Because refinancing is dependent on a contingent future event, which is allowability by a financial institution to allow or not allow that loan. So that is not under the direct control of the company, whether or not the financial institution would allow. And it could implicate that the going concern might be under a concern. And hence, an emphasis of matter is a right thing to be doing for an auditor, to bring it out to the stakeholders, to the regulator, that there are certain concerns that we observe, and this is dependent on an uncertain future event. Whatever you see on these other considerations are key matters that have come out from regular inspections or misreportings or corporate misreporting of frauds that have observed in like last decade or so. The next one that you see is evergreening of loans, and that is something that one has to see is that a lot of companies in India are highly leveraged. Now, how are they meeting those debt obligations? Is it always that they are taking additional debt to meet their liabilities of debt? Whenever installment is getting due, how are they meeting that? Are they able to generate enough cash in the business or not? What are the usage of those funds? So some of those factors have to be seen. And if I talk about ILFS, and if you read the reports that are available in public domain by NAFRA, by others, evergreening of loans was one of the most critical factors that the regulator pointed out in case of ILFS, which led to the ultimate downfall for such a large enterprise. Likewise for DHFL, likewise for some of the other big corporate failures that you would have observed in last 4 to 5 years. Evergreening of loan, going concern implication, refinancing, these three are at the forefront at some of these corporate failures. Another very important factor, the moment you are looking at borrowings, is the borrowing cost capitalization. Now, in a lot of instances, you would see that the borrowing is being taken to fund or finance projects, long-term projects by the company. In such instances, what one must see is that how much of the borrowing can be attributable to such projects, and whatever amount of borrowing is attributable, you must take the cost of that loan onto the cost of that asset. In instances, there could be a specific borrowing for a particular project that makes your task easier because you can straight away take the interest and take it to the cost of the asset. In other instances, while the company may not have borrowed specifically for the particular loan, but they might have a lot of general borrowings. And the moment you have those general borrowings, you have to arrive at a general rate of interest or a average rate of interest that the company is paying to its lenders. And then such funds are that are being used for the project, you apply that general rate and take such interest cost or the borrowing cost to the cost of the asset. So borrowing cost capitalization, this is not optional. This is a mandatory requirement and there's a separate standard on that. But one has to review the borrowings. Then you have to see that how much of those borrowings are being used for long-term projects which are eligible for capitalization. Now, if we were to talk about maybe 5 years ago, then it was whatever we spoke about borrowing cost capitalization, it was the actual interest payout. However, in today's context, it is the effective rate of interest that one has to take to the cost of asset or to your profit and loss account. Now, what is an effective rate of interest? Let's take a very simplistic example. Suppose you've taken a loan of 1 crore, and for taking a loan of 1 crore, you paid processing charges for 2 lakh rupees. 2% were paid as processing charges, and the rate of interest that you've agreed with the bank is actually 10%. So the payout of interest that shall happen would be 10% of 1 crore, which is 10 lakh rupees. However, that's not how accounting shall happen. Now, given that you've paid a processing charges of 2 lakh, the loan, the borrowing, instead of getting recorded in your balance sheet as 1 crore, would get recorded at 98 lakhs, because 2 lakh is the processing charges that you've paid. And you would have to extrapolate the 10% in such a manner that over the life of the loan, for example, it becomes say 10.5%. So you would compute 10.5% on 98 lakhs. That might come at more than 10 lakhs. And you would only pay 10 lakhs to the bank, because the obligation to pay to the financial institution is to the extent of 10% of the actual cash, to the contracted cash, which is 1 crore. So the excess amount shall keep adding to the 98 lakhs so that it becomes 1 crore when you have to pay back the loan back to the financial institution. Now, this difference between the 10% that I'm paying to the bank and the additional 0.5% that I'm accumulating so that the processing charge is spread out over the period of the loan is called effective rate of interest. So while my borrowing rate is 10%, my effective rate of interest is 10.5%. And whether for the purposes of recording an expense in the balance sheet, in the profit and loss account, or capitalization or any other purposes, the rate that shall be used would be effective rate of interest. Another important factor that one has to be cognizant of is the hedging and the forex implication if your loan is in foreign currency. There could be ECBs, there could be FCCBs, there could be FCNR loans. There are separate standards on these, but the moment you talk about hedging, you have to see whether it is effective hedge, ineffective hedge, and I'm sure we would be covering that as a part of a separate session altogether. But whenever it is borrowings that you're looking at and such borrowings are in foreign currency, then you must look at what are the hedging strategies that the company is adopting and what are the forex implications that you have. Last but not the least, there are Schedule 3 disclosure requirements that are there in case of borrowings, which require you to disclose the rate of interest, financial institutions, the covenants that you have, what are the charges that you have created, how much of your borrowing cost is getting capitalized, and there are a lot of other disclosures also which have been added in the revised Schedule 3 that as auditors, as a reporting accountant, one has to look at when we are looking at borrowings. So these were some key considerations, and we can of course take questions towards the end, which have come out from recent developments and also from some of the misreporting, accounting frauds, corporate failures that we have observed in last decade or so. Now we'll quickly go through a audit program of how one would look at borrowings. So this is again, it would depend on a company to company, nature of borrowings, whether these are short-term, long-term, working capital, whether these are in foreign currency or Indian currency. But this is a generic one that I have put on these slides for a large corporate without naming the client, to just give you a flavor of the kind of things one would look at. And these have been picked up from the auditing standards across the board. So this is a generic audit program that one would have for a large corporate while you're looking at borrowings. The first one is you compare the interest expense from a prior year just to see the kind of variances. If there are variances, then we must investigate the reasons for such variance. You perform a reasonable check of the interest expense. So for example, if my average borrowing rate is 8% and my overall borrowings during the year are 1,000 crores. If my interest expense is not coming out at 80 crores, then we look at the variances. So these are some analytical procedures that you would perform. You must definitely look at the loan agreements along with the confirmation the moment you're looking at any agreement, any borrowing. There are a lot of things that are off balance sheet, or there are responsibilities on the company as a borrower that actually come out from a loan agreement only. Covenant testing is extremely important in today's context, especially given that fact that covenant failure may attract penal interest. It may attract the fact that the loan might be classified as current or non-current. Another very interesting thing that comes to my mind is that a lot of times the client would come back and tell you that we would get a waiver from our bank, from the lender, for the covenant failure. And in the past also, we have obtained some of these waivers. Possible? Yes, definitely possible. However, a promised waiver or a proposed waiver, can that be considered while you are accounting for in the financial statements? This has been clarified. And if the client or your company or the one that you're doing is able to obtain the waiver by the time the balance sheet gets signed, then that can be considered. However, something that is promised, something that is represented only that we will get that, is not something that you would consider, and you would account for the penal interest or current liability accordingly. So waiver, if it is received from the lenders, because failure of covenant is fairly common, but if you can get a waiver by the time your balance sheet gets adopted by the board, then that can be considered. If not, then that should not be considered. And that is a very clear position by the regulator in our country. So next is you just recompute the year-end balances by applying the rate of interest. We must also look at, while you're looking at the agreements, are there any defaults that have occurred during the year, whether default in terms of principal payment, interest payment. Even if there are delays, then that requires reporting by the auditor. So that requires disclosure by the company and reporting by the auditor. Any violations with regard to any debt default, again, requires a disclosure. Any current liability or additional disclosure that might be required as per the financial reporting framework that you are required to report on. New agreements, we discussed that agreement is reading of agreements and looking at the terms is of paramount importance. There could be certain conditions precedent in it. There could be certain additional covenants in it. There could be reporting requirements that might come out from new agreements. And another very important thing that comes out from new agreements, even if it is a refinancing of an existing loan, is how are you accounting for the refinancing charges and how are you treating the erstwhile loan processing charges, if at all any unamortized portion is there in the balance sheet. So which is where this would gain importance. Next is the moment you're looking at confirmation, and this is something we discussed, it's not just the balance that we are looking at. We must also look at what are the liens that are there. What are the different pledges that have been created? Are there any collaterals that are there? Is the company authorized to give those as collaterals at the first place or not? So some of those things would come out from the confirmation, and hence reading of confirmation becomes very important. Then for non-current loans and borrowings, we generally confirm the balance at an interim date. So sometimes your balance sheet might be getting signed 20 days after the year end, or you have lesser time and you want to do this procedure in the interim. So in that case, you take an interim date and you roll forward that balance to the year end. Now, the CARO has been revised recently, and this is the first time that we reported under the new Caro regime, and there are several reporting requirements that have come out in the Companies Act itself for an auditor to confirm while you are looking at reporting for borrowings. The first one is on the working capital. Now, very, very common in our country that stock statements are being given quarterly to the banks, to the financial institutions, while loans are being taken. Now, the revised Caro puts that onus on the auditor to see that whether what is being reported to the financial institution as stock or available stock for the borrowings, does it tie up with the books of accounts or not? And if it doesn't, then it is our responsibility as auditor to report it in the Caro that what are the differences. And of course, what shall be the implication of such reporting is something that we would observe. But of course, this gives out a clear information to the stakeholders, to the lenders, that the reporting that is being done or that is required as the loan agreement wasn't being done appropriately. Application of short-term funds, this was there in Caro earlier when Caro initially came in. Then this was taken out, and this has now been reinstated under the Caro 2020, which is one has to look at whether any funds that are used for long-term purposes, whether those are short-term funds or not. So whether the loans have been applied essentially for the purpose that they have been obtained. And this is again an information which is relevant for the stakeholders, for the lenders, but put a lot of onus on the auditor who's opining on the reporting. Default and repayment of borrowings and interest is something that has to be now reported on the Caro, even in instances wherein there are delays. The company might come back to you that now we are not in default. So it is not a default that one has to look at the reporting date, assuming it is 31st March, but one needs to look at defaults that have occurred during the year. And even if there are delays, then those delays needs to be reported in the declaration of willful defaulter. If there are any, then that has to be disclosed in the Caro. Then funds taken from one person to meet the obligation of subsidiaries. So at times we take a loan, but we pass on that loan on to a subsidiary. And you might have discussed in the earlier session with Suprut that, who is the ultimate beneficiary? How are you using your loan? So those reporting requirements are also now being covered under Caro, which puts a lot of onus, I would say, on the auditor. But at the same time, these are important reporting requirements that have been introduced in the current Caro. And lastly, if there are loans taken during the year on the pledge of securities held in subsidiaries, joint ventures, or your other investments, then such disclosure are also required to be made under Caro. So again, if you look at in the overall Caro, there has been a lot of emphasis that has been made on the borrowings that a company is taken. And the very reason of that is that all the big corporate failures that have happened, as I said, borrowings were at the forefront, the core of such loans. And eventually these were unearthed when they were not able to meet up the reporting or the obligations that were falling due. And the reason why some of these additional reporting requirements, some of the additional disclosure requirements that have come out in the revised Schedule 3 is the fact that if these are being observed through the tenure of the company, there would be red flags that would be given out. There would be early concerns that would be rightfully highlighted by the auditors so that the stakeholders, the lenders, the shareholders can take an informed call. And hence, that onus, that responsibility of an auditor has been increased many-fold when it comes to borrowings. Now, so again, this is more generic, but these are the assumptions that one looks at while we are reporting for borrowings. Existence, whether a loan is existing at the year-end date. And when I say existence, the loans that are there on the balance sheet are definitely there, but are there any off-balance sheet liabilities that need to be brought on the balance sheet? And that's where the existence assertion comes into the play. Completeness, whether all interest and loans, debts, borrowings have been rightfully recorded or not. Valuation, what is the value at which that needs to be recorded, whether all penal interest has rightfully been bought out, whether the covenant testing related disclosure have been rightly bought out or not. What are the rights and obligation? And last but not the least, what are the disclosure requirements and the presentation and disclosure requirements coming in from loan agreements, from Schedule 3, from Companies Act, from CARO, and even otherwise, wherever as auditor, as reporting accountant, as CFOs of a company, you feel it is relevant for you to give out that information with regard to borrowing to the stakeholders, to the lenders, such disclosure should rightfully be made in the financial statements. So that is all we had in terms of borrowings. I mean, for each case study, each thing we could spend more time, but that's in brief covering the entire gamut of and in a brief manner how borrowings needs to be looked at from an audit perspective. I'm happy to take more questions on any clarifications that you might have.
Thank you so much, Amit sir. Thank you so much. You have elaborated in a very good manner, and you have explained all the aspects of the borrowings. We have received certain questions relating to these borrowings.
Sure.
So first question is, of late, there have been reports of accommodation entries provided by certain private limited companies to the other corporate entities.
Right.
If you kindly clarify whether these accommodation entries fall within the scope of loans.
See, I would not know what and how would you classify something as a accommodation entry, but some of these additional reporting requirements. So suppose the corporate is classifying them as loan. So I guess that's where, as an auditor, you must look at what is the purpose for which that entry has been passed. Who is the ultimate beneficiary? Whether the funds that have been proposed or shown as being funds that are being shown are being used for the purposes that they've been obtained for. And by virtue of these reporting requirements under CARO, if I'm getting that meaning right, if there are any such accommodation entries, then those disclosures would come out very clearly in the CARO for the regulator, for the others to see that these loan entries or the disclosures that have been made are not appropriate. So again, that puts a lot of onus and responsibility on the auditor. But with the new CARO reporting requirements, it would come out clearly, I would say.
Yes, sir. Sir, there is a question come practical question. So I am just going to elaborate. Can a private limited company borrow money from a trust or partnership firm? In the said company, now the example is, the question was can a private limited company borrow money from a trust or partnership firm? In the said company, there are 4 shareholders and directors, being husband, wife, and 2 sons. In the partnership firm, the partners are mother and 2 sons. In the trust, the trustees are all 4. The trust has obtained collateral security, and the rate of interest charged is 2% more than the bank deposit rates.
So, Anilji, see, whenever there is a private limited company, I think the rules are far more relaxed. Okay, because eventually they are the stakeholders, and with board resolutions, with shareholders resolutions, a lot of these things can be done. However, what is our responsibility as an auditor? First thing is that loan prejudicial to the interest of the company or not? So that is one thing that the auditor has to see. Second, when I say prejudicial, both rate of interest and that loan. Second, are you making the right disclosures required as per the related party standards and the Companies Act for taking off such loans or not? And third, is there anything by virtue of articles of association of the company, memorandum of the company, or their other arrangements with the bankers that stops them from taking such kind of a loan, then that would come into the play. And these are some of the regulatory and reporting requirements that the auditor would be required to check. But in a private limited company, doable or not for a related party transaction, definitely doable. But one has to carry out a vigil which is more than normal the moment there's a related party transaction.
Yes, sir. So how do we check if the quarterly stock statements filed with the banks or financial institutions are the same provided to us, and how to check the authenticity relating to the same?
So authenticity is something that that would go for any evidence. So why a stock statement? So if a company is giving you a voucher, the way you would look at whether it is a right voucher or a statement or not is the same kind of skepticism that you would apply for a stock statement. However, with the new CARO, what the auditor is required to do is that look at the books of accounts as to how much was the stock quantity that was recorded in the books of accounts and what has been reported to the bank, and what are the controls that the company is having to make sure that the reporting going out is right or wrong. So I think that is more a responsibility of an auditor. For checking the authenticity, I think it is a usual skepticism that you would apply on any evidence that the company is giving you as a part of your audit process.
Sir, last two questions relating to the borrowings relating to the foreign currency.
Yeah.
One member is asking, how do you differentiate between cash flow hedge and fair value hedge relating to the borrowings in foreign currency, and what are the implications of the same in the books of accounts?
So again, so again, it is a full standard in itself. So I'll very briefly summarize. So whenever you are designating the cash flows as a instrument that you are evaluating, it is called a cash flow hedge. And whenever the derivative itself, the value of a derivative is being considered, then you classify it as a fair value hedge. The implication of that is more around hedge effectiveness. And why it is important is because if it is an effective hedge, then any foreign currency movement would go to a reserve and would not impact your profit and loss account. But if it is not an effective hedge, then any foreign currency movement would hit your profit and loss account. So to avoid that fluctuation in profit and loss account, the companies intend to create a documentation for their cash flow and fair value hedges to make sure that those can be classified as effective hedges. So I think it's a much more elaborate standard for me to answer that, but the relevance comes in whether or not the hedge is effective. And if it is effective, then the foreign currency movements go to a reserve and not to the profit and loss account.
So last question relating to the loans. A private limited company has huge unsecured loan taken in the earlier years, but not providing interest on the loans. Is the auditor supposed to do in this particular case?
So I think this is if they are required as per the agreement as to provide for that, it is a clear case of underreporting of liability. As an auditor, it is our responsibility to make sure that the right disclosures are made. And I would go to the extent of saying if the loans are material and the interest amount is material to the reading of those financial statements, then the auditor must also consider putting a modification in the auditor's report also, because the liabilities in this case would be understated than how they should be. I mean, it is not relevant whether it is a private limited company or a public limited company. But if the liabilities are understated, it is a responsibility of the auditor to make the right disclosure, to have the right amount recorded. And if not, then a modification, if the amount is material, should be made in the auditor's report.
So last question. What is the disclosure requirement in case of a foreign currency convertible bonds? Whether need to be bifurcated between equity component and borrowing, or considered as equity component only, or whether equity component need to restate at the end of the financial year?
Very relevant question. And this is less of a borrowing standard question, but more of a financial instrument question, but I'll still give a brief. So whenever there is a foreign currency convertible instrument, one has to look at and whether what is the likelihood of conversion. Okay, if it is 100% and you can derive the number of shares that would be converted by virtue of that instrument, and it is likely that and probable that it will be converted, then the entire amount is classified as equity. If it is probable that none of it would get converted, then the entire amount should be classified as loan. And if it is not clear, then you record it as a compound instrument wherein part of it would be recorded as equity and part of it would be recorded as debt. So there is no real or a single answer to that. It would be circumstantial. But the moment there are any borrowings, whether FCCB or FCNR or anything, which have a conversion instrument to it, then as per 108 principles, one has to look at and apply the principle of compound financial instruments to arrive and derive that whether it should be classified as debt, equity, or both.
So can you hear me?
Yeah, I can hear you, Anil.
So thank you so much, Amit ji, for sparing your valuable time. And once again, from the core of my heart, on behalf of AASB of ICI, I extend my heartiest thanks. You have spared your precious time and you came out of your audit committee meeting. Thank you so much. Thank you so much. Once again, sir.
Thank you, sir.
Thank you. Thank you, sir. Thank you.